Hey there, welcome to Insomniac Learns. Tonight, we're diving deep into a topic that affects millions of people every day: credit scores. You might think a credit score is just a simple number, but it's so much more. It's your financial reputation, your key to better loan rates, credit cards, even renting apartments or getting hired at some jobs. Maybe you've seen a number and wondered how to raise it, or you've been told different things about what affects your score. In this video, we'll cut through the confusion, explain everything in detail, and reveal proven ways to fix your credit score if it's not where you want it to be. So grab a drink, get comfy, and let's get started. Let's start at the beginning. What exactly is a credit score? A credit score is a three-digit number, usually between 300 and 850, with higher numbers meaning you're more likely seen as trustworthy by lenders. Think of it as your financial grade, reflecting your borrowing and repayment history. This score is calculated from your credit report, which tells a story about how you've managed credit, your loans, credit cards, and sometimes bills like utilities if reported. The three main credit bureaus, Experian, Equifax, and TransUnion, collect and update this information. Lenders report your actions to them, and your score updates as a snapshot of your current credit health. But not all credit scores are created equal. The most common is the FICO score, used by over 90% of lenders. There's also the Vantage score, which some lenders use. Different lenders might use different versions or models of these scores. Do you know what your credit score is? Have you checked recently? If not, that's a great first step. Understanding what affects your score is where the power lies. Payment history, 35%. This is the biggest factor. Every account you have is monitored for whether you pay on time or miss payments. One late payment can cause noticeable drops, and the more recent and frequent late payments, the worse it is. Imagine you had a credit card payment due on the 1st. If you pay even a day late, your score can tank. But on-time payments build trust over time and steadily raise your score. Bankruptcies, foreclosures, and collections are also recorded here and have a huge negative impact. They remain on your report for up to 7 or even 10 years. Amounts owed, 30%. This factor reflects your credit utilization ratio, how much credit you use compared to how much you have available. For example, if your total credit card limit is $10,000 and you owe $3,000, your utilization is 30%. Experts recommend keeping this ratio below 30%. Some even say below 10% is ideal. High utilization signals to lenders you might be a high-risk borrower, possibly carrying too much debt. Paying down your balances regularly can quickly improve this and boost your score. Length of credit history, 15%. Older accounts help your score. This factor considers the age of your oldest account, youngest account, and overall average age. Opening a new credit card can reduce your average age and momentarily drop your score. But over time, as it ages, it will help. Patience is key here. If you're new to credit, it's normal to have a shorter credit history, which means your score starts lower but grows as you establish accounts responsibly. New credit, 10%. Every time you apply for credit, a hard inquiry occurs. These inquiries can lower your score by a few points temporarily. Applying for multiple new accounts in a short period can compound this effect and lower your score more significantly. If you're rate shopping for a big loan like a mortgage or auto loan, multiple inquiries within 14 to 45 days may count as one inquiry, depending on the scoring model. Credit mix, 10%. This factor looks at how many different credit types you manage. Loans, mortgages, credit cards, retail accounts, all contribute. Showing you can handle various credit types effectively is a positive signal. But don't open accounts just for variety. Only take on what you need and can manage. There's a lot of confusion out there. Here are some common myths to clear up. Closing credit cards always helps your score. Actually, closing accounts often shortens your credit history and reduces your available credit, which can lower your score. Think carefully before closing cards, especially older ones with no fees. Checking your own credit score hurts it. This is false. Checking your own credit is a soft inquiry and has zero impact. You should monitor your credit often to catch errors or signs of fraud. Carrying a balance improves your score. Nope. Paying your credit card balances in full each month is best. Interest charges add up otherwise, and low or zero balances help your utilization rate. Debt collections disappear as soon as paid. Unfortunately, no. Collections can stay on your report for up to 7 years even after paid, but showing payment might improve lender perception. You have the right to one free credit report every year from Experian, Equifax, and TransUnion at annualcreditreport.com. It's important to check these reports for errors, outdated info, or signs of fraud. Mistakes like incorrect late payments or fraudulent accounts can drag your score down unfairly. If you find an error, file a dispute with the credit bureau. You can do this online or by mail. They must investigate within about 30 days and fix errors if confirmed. Improving your credit score requires patience and habits but is entirely doable. Always pay your bills on time. Set automated reminders or payments. Even one missed payment can drop your score dramatically. Keep your credit utilization low. Aim for less than 30%, ideally under 10%. Pay down balances as quickly as you can. Avoid applying for lots of new credit. Space out applications to minimize inquiries and preserve score. Keep older accounts active. Don't close old no-fee cards. They help your average account age and available credit. Diversify gradually. If you only have credit cards, consider a small installment loan once comfortable. Manage debt collections carefully. Pay what you can and negotiate with collectors to possibly remove negatives. Use secured credit cards if rebuilding. They require deposits but can rebuild credit responsibly if used well. If you're overwhelmed or behind on payments, nonprofit credit counseling agencies can help create budgets and repayment plans. Avoid credit repair services promising instant fixes. Many are scams or charge hefty fees without real results. Let's answer some common questions viewers ask. How soon can I see credit improvements? What if I'm a student with no credit history? Can I remove bankruptcies early? Does paying off debt always raise my score? How do credit scores affect interest rates? Thanks for watching Insomniac Learns. Remember, improving your credit score is a marathon, not a sprint. Stay consistent, practice good credit habits, and your financial future will improve. If you found this helpful, please like, subscribe, and ring the bell. Sweet dreams, and see you next time.